The Dow hit a record high.
Holding steady.
The economy.
Oh, we got your back, Jack. Make a great plan, man. A real McCoy, Troy, our 3 cents for free. The options to pick, Nick. You need to discuss much. You got the key, KC, in exit strategy.
Welcome to our 3 cents, Henssler Financial Production, about business valuation and business exit planning. And KC, as you love to say, go ahead. Business exit planning is
it's good business strategy.
There you go. Good business strategy. So I'm Troy Harmon. I'm here with KC Smith and Nick Antonucci, and we want to talk today about valuation. So how do you want to kick this off, Nick? I guess, why does somebody get a valuation?
Oh, it can be a number of reasons. And I think, that's a great jumping off point, Troy, because as we'll get into the methods of valuation, the purpose of the valuation to some degree will dictate the method of valuation, right?
Absolutely.
So it may be for tax purposes that you're getting a business valuation. It might be.
What would that entail? I mean, if the business is closing down and you want to tell them what you just lost, maybe?
Yeah, that may be one of the scenarios. Perhaps you gifted part of the business
to a family
member, friend, whatever it may be.
Inside manager.
That's right. And you need to determine the value of what you gave away.
Yeah. Tax man wants to know that too.
Yeah, they want to get paid. Absolutely. It could be divorce, could be death or transaction. Maybe you're just selling shares.
Yeah, bringing in a new partner.
Absolutely. The list goes on and on.
Right.
But that is absolutely where you need to start, because if it's something so simplistic as, let's say, one shareholder selling to another shareholder, and you have an agreed upon method that the valuation will be based off of, as we discussed in previous episodes, a buy-sell agreement, then there might not be a need to go through the three approaches that we use, which is the market-based approach, the income-based approach, and the asset-based approach, which we'll get into here shortly. But it may explicitly say it will be based on the market-based approach. Well, if that's the case, you're going to save yourself money by getting a calculation of value done using one method, as opposed to having a valuation analyst conduct all three methods and give you a value.
Yeah, a conclusion of value, they call that, when you do all three of those methods, right?
That's right.
So what's probably the most common note that you get, Nick, when somebody comes in and says, I want a business valuation, my buddy tells me
it trades at 3 times EBITDA, or 5 times sales, or something like that.
It's usually EBITDA.
It's the market-based approach. It's
right.
The most common way. If you think of valuing publicly traded companies, a lot of times we speak to valuation in terms of price to earnings, price to sales, price to EBITDA.
Sure. It's just like selling your house, right? It's like my neighbor just, houses in the neighborhood are going for $400,000 each. So I think mine's worth $425 because it's a little bit bigger or whatever. I mean, that's
exactly.
What it is.
You're finding comparable companies.
Yeah, exactly.
The problem we run into, as you're alluding to, Troy, is that an individual comes in, my neighbor sold his business for 6 times EBITDA. Well, that's great. Well, what was your neighbor's business? Is it the same industry as yours?
No, he was a doctor, and I work on motorcycles. Does that matter?
Absolutely, that matters. Absolutely, that matters.
And his business was in New York City, and mine's in Ackworth.
Yeah. So there's a lot of variables that go into, just like you're saying, Casey, with homes. Homes can be extremely different, despite the fact that it's one right next to the other.
Yeah, exactly.
And so what you need to find generated $100 million in revenue and yours generated $1 million in revenue.
Yeah, should get the same multiple, right?
Yeah, sure. Why not?
So there's things you need to determine within your business, strengths and weaknesses, what's unique to your business. It could be that yours demands a much bigger multiple. Maybe you're growing much faster. You have bigger margins.
Yeah,
it could be a number of different factors that play into the valuation. So we constantly try and stress to our clients, you can't just throw this random multiple, average market multiple on your business, because it could be a lot more, could be a lot less.
Yeah, unfortunately, Nick, what we wind up finding is when somebody leads off the conversation like that, they really haven't put much thought into why their business would be different or very similar. More often than not, KC's going to get to call somebody's baby ugly in a second. More
my favorite
often
part
than
of the
not,
show.
Yeah, more often than not, somebody will come in and they've poured their heart and soul into this thing for 10 or 20 or 50 years, however long it's been. They're very emotionally attached to this thing. And when you talk about what the business is worth, you're talking about the average multiple, right?
Nobody has an average business.
That's
Everybody's
right.
business is above
If
average.
you talk to them about the business itself, it ain't average.
Yeah.
But they want to use this average multiple. So we have never had somebody come in and say, well, I think the multiple should be 5 times because that's what my accountant said. And that I think because it's growing faster that it should actually get 5.5. They never say that. They only want to say, well, what is it going for? They take the market's advice without any question.
Well, and here's the other thing, guys, is that oftentimes an owner who's looking to exit their business is not thinking about, they're looking at the value just by itself. And, however the valuation method is used or what have you, they're also not considering what are the terms of that exit. Somebody could get a higher multiple by having, restrictive terms on the deal where, it's going to be paid out over a longer period of time. There's going to be earnouts. There's going to be performance metrics in there that they have to hit and things like that would maybe be better off to get a lower value but more favorable terms.
Right.
So getting a professional business evaluation, you get an objective opinion. It removes what you think as the owner are the strengths of your business. It looks at the reality of the situation, especially in the income approach, I feel more so because, we're getting down into the financial ratios of everything and we're seeing on a numbers basis, is your business operating in line with its competitors?
Well, let's talk a little about what we're dealing with here. A business is an investment. Every investment, I don't care what it is, if it's a piece of rental real estate, if it's a stock in the stock market traded on a public exchange, or your private business, that investment is worth the present value of its future cash flows. So, Nick, you say something about an income approach. The income approach can go various different ways, but ultimately that is a calculation. It's first of all, you look at the history of the business, how its performance has been year over year for X number of years in the past. Obviously, you and I want 10 years. How often do we get that?
In very few instances do we get that.
10 years, yeah. So it's
5 is more likely.
3 to 5 years, they'll have operational history they want to share. You look through that. You project into the future what the business is going to, how its operations are going to work. And then you take their weighted average cost of capital, which can be fleshed out at some point in the future. Maybe not even then. Basically, it's how much it costs you to source cash in order to run the operations of your business. You use that as a divisor. You bring the business value back to present value. So let's put the pointy head stuff behind us. It's real easy to use the multiple approach, right?
It is.
The multiple approach does not account, as you've already said, Nick, for growth in the business. If this business is growing at 5% or if it's growing at 15%, the multiple gets applied evenly.
That's right.
That doesn't make sense because a business that's growing at 15% is going to have a more robust future cash flow.
Could also work in your favor, but
that's true.
But, kind of what all this discussion makes me think, Troy, is this is a jump, whatever the valuation comes back to be, it's a jumping off point because as you're talking about future expectations in the income approach, there are a lot of assumptions made in this.
Absolutely.
We don't know what the future holds. We're making a best estimate as to what we think future results will be. So there is, potential for error one way or the other. Could be much better than we projected, could be much worse.
Well, we see recessions occur somewhere between every 5 and 10 years, right? Have you ever seen
historically?
Have you ever seen a business analyst, a valuation analyst, build into their next 10-year cash flow assumptions a recession? You ever see that? Yeah, me either. It's weird.
It is weird
how that works.
No, it is interesting, and you guys bring up a good point about the growth because I think that's what a lot of business owners, and not to call their business they're baby ugly, like I tend to do.
Yeah.
But they think that
Casey.
whatever the growth rate is today or has been over the last 5 years is just going to continue, and it's going to even get higher forever. And
Yeah,
it's
let's talk
never gonna
about
go down.
2021. Why are we supposed to have a growth in the economy of what is like 6%?
Yeah.
Yeah.
So that's going to be normal? No, what was it last year? Negative what?
A lot. And in one quarter, 30
I
something
was about to say,
percent.
it depends on what quarter you're looking at.
Exactly. So, the thing is, growth is not steady. What you want to do is use the longer term approach. You look at it, we could probably both agree if we were going to look at just economic growth of the whole economy, 3.5%.
Yeah, that tends to be what we look at terminal value.
Yeah.
Terminal value, we say if the business is going to grow in perpetuity, right? We're not going to,
forever
we might
without
forecast
change.
10 years of growth at different rates, and then eventually it's going to, mature and grow at a constant rate.
And that's the thing. Businesses mature. They grow fast for a while, usually, and successful businesses anyway. They grow fast. Then they get to a point where they mature and they plateau for a while. And then,
that maturity is due to the fact that, they get large.
Yeah,
And once
exactly.
they're at a certain level, it becomes much more difficult for them to grow.
yeah.
You have to become an acquirer of other business.
It's hard to have this
various
conversation
other
in today's
strategies.
environment when you look at, public markets and look at some of the valuations out there that they're using these same methods to value public companies as you do a private company.
And there are extremely high expectations for growth
Right.
built in as assumptions.
Right.
Of the overall market. You're absolutely right, Nick. And the thing is, one thing that we see is when public market valuations are really high, you can look at the price to earnings ratio, forward or reverse, the trailing 12 months or the next 12 months, expectations on earnings or the history earnings. When you start seeing those valuation numbers really high, it actually translates into private businesses selling for a bigger value as well. So, right now is probably a great time to sell. Right now, when is right now? It's April of 2021. Valuations in the S&P 500 are really high. Your valuation multiples, if you're just going to use that EBITDA number or price to sales, as Nick noted, you're probably going to get a pretty good premium at the moment.
Exactly. Yeah.
So buyers need to be mindful of that for sure.
And this comes back to some of the discussions we've had on previous shows about timing. Trying to time an exit, just like trying to time the stock market, is very difficult to do. So that's why you got to do your planning early. Make sure that you're ready when the time comes. If you are ready, then and everything is rosy as it is now, then maybe it is a good time to look at exiting your business. But
think about a year ago, though. Think about what would be. Yeah.
What if you thought you were going to sell your business last year in April and you got ready to do it, and then the
world
bottom
fell apart,
falls out of the economy and everything else.
Yeah, it makes for difficult conversations for sure.
Yeah.
Well, the thing is, Casey, I think everything we are always going to say is going to come back to plan, and implement the strategy. I mean, whatever it is that you're looking for, you're always going to be better off.
Sure.
To have considered everything.
And I want to touch on two more things. Lastly, we've talked market-based approach to valuation, right? We've talked about the income approach, and kind of last but not least is the asset-based approach, which basically takes...
That is least, Nick.
Yeah, that is the least. I guess that's a fair point.
Least.
That's a fair point, Casey. That is the least.
More often than not, it is the least.
Yeah, it's your last resort, and it's the least amount of money you're going to get on the exit. When we talked exit strategies, the final one we talked about was liquidation, and that's essentially what the asset-based approach is. It's like a liquidation value.
Yeah.
So you look at the balance sheet, you take your assets, you take market value of those, subtract out market value of your liabilities, and what's left?
Yeah, it's a book value. It's precisely what you're dealing with.
It's the
now,
most simple.
We've actually looked at businesses where the owner has passed. Mm-hmm. And we have made a determination, because the owner was so integral in the daily operations of the business. Without his tutelage and his connections to his clients, the book value was actually not the least. Yeah. Believe that or not. He had assets laying around that could be liquidated, but the operations intangible asset was so rooted around the owner that that
With him,
intangible.
what the value of that intangible.
Precisely.
That's true. It may not always be the least. I just tongue in cheek.
More often
No,
than not. More often
Casey,
than not.
95% of the time, it is the least.
Book value
I'm just
would not
saying
be.
it's not always. So,
that's
you
a
need
good
to
point.
consider these things. If you've got a distressed business, quite often the best money they can get is out of selling the assets and walking away.
Yeah, and we say you get a business valuation, it's your jumping off point. Well, at that point, this is where we can begin the talks of what I can expect to get. But again, as we've mentioned in previous episodes, knowing what you actually need is extremely important as well.
Yeah.
Because that allows you the flexibility not only to negotiate the number, but also the terms of the deal.
Exactly.
Well, here's the thing. You're not going to go in there, and I know I teased this in a previous show talking about this valuation discussion that we were going to have today. You're not going to go in there and say, my business is really not worth it, but I need $5 million. You can't get blood from a turnip, and there is nobody in their right mind that's going to give you an amount that is not going to be at least somewhat rooted in the economics of your business. So, again, it's wise to plan. It's wise to try to make sure that your business is valuable as you can make it.
And planning as well, Troy. It's not even to the point, we say start your planning early. And evaluation doesn't necessarily only need to come at the end when you're ready to exit. I think there's plenty of business owners that it would do them a lot of good to have a reality check as to what it's actually worth, because as we've discussed, you come in here with this pie in the sky number that's so detached from reality.
Yeah, and it comes down to also the terms, because most of the time when we're talking, at least on the personal financial planning side, when a business owner comes to us and says, I need a personal financial plan, I want to know when can I retire, what do I need to sell my business for, et cetera. Most of the time they're going to assume that whatever the value that they have in their head, whether usually a multiple of EBITDA or sales or one of these market-based
More
approaches.
often EBITDA than sales, but sales, believe it or not, is the easiest one for us to find as valuation analysts.
Sure.
Yeah.
But they're gonna give you a number and say, I'm gonna sell my business for $5 million in 10 years. Okay.
In times past, did you ever question that, Casey? Just jot it down on the paper.
I mean, what are you gonna do? I don't know anything about the business at that point. It's I kind of have to take your word for it. But can you really expect, maybe the business is worth $5 million, but are you going to get that as a lump sum?
Yeah.
Depends. I mean, maybe not, but we might want to look at the terms again to
Casey,
figure out.
that's actually an awesome point. And the reason that it is no matter what Nick and I might do as a business valuation analyst, we might come up with a number, say it's $10 million.
Yeah.
Well, 10 million would assume that, there's a couple of things Nick and I hadn't even talked about. There's called discounts.
Yeah.
You've got discounts usually for lack of marketability. You might have a key man, or they're rare, but a key person discount for, the owner might be so integral to the business, as I mentioned in the previous example where an owner had passed suddenly. That makes the business worth less, not worthless, but worth less for sure. But the
lack
other thing,
of control too.
The thing is, and lack of control. So if you're selling less than a controlling interest in the business, maybe you've got 3 buyers and 2 of them are going to take a 10% interest and the other is going to take on 80% of the business. The price will be different for those 3 buyers.
For sure.
But the thing is, whatever number we come up with is a starting point to the negotiation, as you both have already said. But then think about this. If you're going to sell it over time, you need to treat it like the bank would. What's the bank going to do? They're going to try to determine how much risk is in the fact that I might not get this back.
Yeah, you're a creditor at that point.
Exactly.
Which I'm glad you brought that up, Troy. It's like something that we certainly should touch on in future episodes, and especially when we were talking about the methods of exit. But the second bite of the apple, really what you're talking about, you might only sell 20% right now, and you take some money off the table, and then you grow that business further over the next 10 years as an 80% owner, and then you sell it to, a private equity firm or something, you get the second bite of the apple. You took chips off the table in the beginning, you grew the value even more, and then you got to sell the other 80%
Sure.
at an even higher valuation.
Kind of a stepped approach to retirement.
Yeah,
I mean,
exactly.
that might be a wise move too.
Yeah, diversifying out along the way. I mean, that's what we would recommend if you had a highly concentrated position in one stock.
Well, it also helps you manage the tax situation,
Exactly.
right,
Yeah,
Casey?
because that's another factor that we haven't talked about a whole lot to this point. Is it's not just the pre-tax value of the business. How much are you going to be left with after taxes? And
in every situation, it is the after-tax value of your business that is most important to an individual.
Yep.
So
nobody goes in saying that I'm going to get 5 times EBITDA minus whatever 35, 40, 50% taxes.
Yeah.
You think $10 million, I'm getting $10 million.
Yeah.
No.
Slow down, because
simmer down.
Uncle Sam's going to get half of that, right?
Uncle Sam's going to take a chunk, and
He will take his every single time. So maybe a stepped approach is best. All right, guys, we'll wrap it up. You got anything more to say on the topic of valuation? There's a whole lot of things that we could talk about. This could go on forever, but there's no need to belabor the point. If you have questions, you can give us a call, 770-429-9166. Ask for Troy, ask for KC, or ask for Nick. Any one of us can help you answer your questions on business valuation, financial planning. I'm not going to answer your questions, but I'm going to give you KC's number. We're here
we
to
can even help you with taxes.
There you go.
John
Yeah,
Dixon
we've got tax experts on the
Insurance.
Estate planning, insurance.
That's right.
All your financial needs.
No doubt. And we
One
can also
stop.
help you negotiate with a buyer or seller, just depending on which side of the table you sit on.
That's right.
We've been in these deals. We'd love to talk to you. Give us a call, 770-429-9166, or you can go to our website, Henssler.com, or you can email us, drgene@henssler.com. That's spelled DRGENE at HENSSLER.com. We appreciate you listening.
You just need to commence, gents. Make a great plan, man. A real McCoy, Troy. Our 3 cents for free.
All material presented is from sources believed to be reliable and current, but accuracy cannot be guaranteed. The contents are intended for general information purposes only. Information provided should not be the sole basis in making any decision and is not intended to replace the advice of qualified professionals, such as tax consultants, insurance advisor, or attorney. Although this material is designed to provide accurate and authoritative information with respect to the subject matter, it may not apply in all situations. This is not to be construed as an offer to buy or sell any financial instruments. It is not our intention to state, indicate, or imply in any manner that current or past results are indicative of future profitability or expectations. Portfolio holdings discussed are subject to change. There is no guarantee that in the future these securities will be held in the Henssler accounts. As with all investments, there are associated inherent risks. Please obtain and review all financial material carefully before investing. Henssler is not licensed to offer or sell insurance products. This overview is not to be construed as an offer to purchase any insurance products.